Good morning. Welcome to the accounting basic. Before proceeding to the next part of our ज्ञान से कल्याण program, अक्षर ज्ञान, each one teach one, I, Dr. Baidyanath Ram Prajapati, seek blessings of Almighty God and Yogi Raj Umeshwaranand Ji Maharaj, whose inspiration, guidance and all way happiness is we are enjoying. So, my dear friend, this is for basic of accounting for class 11, 12, BCom, BBA, MCom, MBA, CS, CS, ICWA, and the person who are practicing in different organization. So today we are going to see accounting for partnership. So this is a very brief introduction of myself. So basic concept of partnership. Section 4 of the Indian Partnership Act 1932 defines partnership as a relationship between persons who have agreed to share the profits of a business carried on by all or any one of them acting for all. So we have already discussed all over the world. Basically, all the business organizations are managed, controlled and operated under three basic form of organization. The first one is sole proprietorship, where single person is whole and sole responsible for all the activity. Next very important one which we are discussing, that is the partnership, where two or more persons are joining hands for doing the business. And the third one is company form of organization, which we will see in the coming sessions. Partnership characteristics. There are certain features of partnership. Here there are two or more persons. They are working for a common goal and there is an agreement between them to do the business, to share the profit and to do all activity. There must be a business and the sharing of profit. It may be agreed or in absence of partnership deed. This will be shared equally between all the partners. So the liability of partnership are jointly and severally liable to other partner and also severally to the third party for all the acts of the firm done while he is in partner. So my dear friend, so here there is an agency relationship between partners. One partner is responsible to the other and other partner is also responsible to the other, and all are responsible to the outside world. Next, very important today, this is very familiar in organizing business, limited liability partnership, LLP. It is an incorporated partnership formed and registered under the Limited Liability Partnership Act 2008 with limited liability and perpetual succession. Perpetual means continuous. It is viewed as an alternative corporate business vehicle that provides the benefit of limited liability but allows its partner the flexibility of organizing their internal structure as a partnership based on a mutually arrived agreement. So this is very important form of organization. This is a part of partnership form of business organization, and this is the combination of partnership and company form of organization. So here the benefit of partnership and the company form of organization is available. So here few features of limited liability partnership are expressed. So limited liability partnership is a corporate and legal entity separate from its partner. Every limited liability partner shall have at least two partners and shall also have at least two individuals as designated partners, of whom at least one shall be resident in India. This is the basic and fundamental conditions for the limited liability partnership. The Indian Partnership Act 1932 shall not apply to this LLP. The limited liability partnership has perpetual succession, continuous operation. The central government has power to investigate into the affairs of a LLP if required by appointing a competent inspector for this purpose. So next one is very important, partnership deed. The Partnership Act does not require that the agreement must be in written, but wherever it is in writing, the document which contain terms of the agreement is called partnership deed. So partnership deed is a charter and it is a written agreement between the partner which specify the various terms and conditions for the operation of the business. So my dear friend, here one test is provided for the self-examination and this will enhance our knowledge. So here suggested answer is given. So now we are proceeding to the advantage and disadvantages of partnership firm. So forming a partnership firm, how we can form a partnership firm? Each partner's initial investment in a partnership should be recorded at the fair market value of the assets at the date of the transfer of the partnership. So in partnership, a partner can contribute cash and he may contribute amount in other than cash. If he has some assets which is useful for the business, he may contribute. So the assets that is contributed by the partner be valued at market price at the date of transfer. The value assigned must agreed by all of the partners. After the partnership has been formed, the accounting is similar to accounting for transactions of any other type of business organizations. We have already discussed in our previous slides. So now we are dividing the net income or net loss as we have discussed. In partnership deed, it is specified in case of there is no partnership deed or in absence of partnership deed, the profit or loss is shared equally unless the partnership contract specifically indicates otherwise. The same basis of division usually applied to both net income and net loss and is called the income ratio or profit and loss sharing ratio. A partner share net income or loss is recognized in the account through closing entries. How the closing entries are made? Here a few example is given. There are 4 closing entries are required for partnership. Debit each revenue account for its balance and credit income summary for total revenues. Debit income summary for total expenses and credit each expense account for its balance. Debit credit income summary for its balance and credit debit each partner capital account for his or her share of net income or loss. Debit each partner capital account for the drawing or interest on drawing. So income ratio, as we have already said, already discussed, it may be fixed ratio, here example is given, or a ratio based on either capital balances at the beginning or the average capital during the year. How the new partner can be admitted? So a new partner can be admitted with the consent of the other partners. A new partner may be admitted either purchasing the interest of one or more existing partner or investing assets in partnership. How a partner can withdraw his right from the partnership firm? A partner may withdraw from a partnership voluntarily by selling his her share to the other partner, involuntary by reaching a mandatory retirement age or by dying. मरने पर या रिटायरमेंट एज होने पर एक पार्टनर रिटायर कर सकता है, या जैसा कि पार्टनरशिप डीड में लिखा गया है उसके अनुसार एक पार्टनर पार्टनरशिप फर्म से अलग हो सकता है. So the withdrawal of partner may be accomplished by payment from remaining partners' personal assets or payment from partnership assets. So how a partnership is liquidated or liquidation of partnership firm? The liquidation of a partnership terminates the business. To liquidate a partnership, following steps may be followed. Sell non-cash assets for cash and recognize any gain or loss on realization. Allocate any gain or loss on realization to the partners based on their income ratio. Pay partnership liability in cash or distribute the remaining cash to partnership based on their capital, or partner may take liability or assets as agreed, or this can be liquidated as per the agreement written in the partnership deed. So this is the causes or reason for the liquidation of a partnership. No capital deficiency, partner with deficiencies, paid partnership, partners may credit capital balance, absorb deficiency in income sharing proportion. So my dear friend, here is the brief introduction of the trust, Vishwa Manav Kalyan Charitable Trust. On behalf of this, we are providing the services. So you may join or donate for help. Here our concept is each one teach one, or Akshar Gyan we should provide. We should literate one illiterate person. So thank you.